All right, so in this video, I'm gonna go over why I recently invested into Google. I'm gonna go over what I saw in the company, my timeline for holding this position, and any future opportunities or risks I see in the company. So first off, market cap is at 2 trillion, PE is at 18, free cash flow yield is at 3.5, and dividend yield is at 0.47%. Their PE ratio is actually far lower than any Mag 7 company out there. It's the lowest out of the Mag 7, and the free cash flow yield is looking very good as well. I think it increased like 1% within a couple months, so that looks like a very, very good valuation. If we look at their price, I mean, for the past 5 years, it's gone up, but the past year to date, it's down 9%. If we look at its revenue, I mean, this is exactly what you want to see in the company, right? This is exponentially growing revenue for Google. If we look at the past 5 years, same thing, right? Increased around 13% averagely for this year. In 2 years, it was like 2.4% average. So that's very good in terms of revenue. If we break down that revenue, you could see that most of it came from Google Search, which they've been monopolizing over forever, right? They own like a minimum of 90-something% of the complete Google Search market share, right? The second is their Google Cloud, which is another big revenue. If we just look at it closely, you can see that Google Cloud has been increasing a lot. I mean, it's crazy how much scalability the Google Cloud has had, especially because their operating margins for the cloud have finally entered positive and doubled for the past year. I mean, the amount of opportunity for Google Cloud is insane, right? If we look at the other stuff like Google Search, it's been consistently growing. YouTube ads is another strong moat. YouTube is going to be very relevant for the next couple of years. Google Network is the only revenue stream that's been kind of slowing down and depreciating a little bit, but I'm honestly not too worried about it because almost every single other revenue stream has been growing and making up for it, right? Especially other bets. Now, the other bets include Waymo, which is autonomous driving. Everyone knows Waymo. Wing, which is like a drone delivery company that they're experimenting with. Calico, which is a biotech company that I think specializes in anti-aging. I might be wrong. And then let's see, what else do they own? Capital G, which is like their venture firm or private equity firm, one of those. And a bunch of other bets. But in my opinion, the number one bet that I'm looking at, and that's already about to pay near term, is Waymo. I mean, if you look at Waymo's weekly taxi or weekly rides, it's exponentially growing as well, right? And other competitors like Tesla and Zoox, they're not even launched yet. Tesla recently launched this week, right? They've just been born, and Zoox is not going to launch until later this year. So Waymo already has a big advantage compared to robotaxis and Zoox. So I'm very optimistic about Waymo and their territory. They've grown their territory massively throughout San Francisco, Los Angeles, and recently they've been experimenting with trying to enter in New York City, which in my opinion, I think it will take some time for them to enter New York City due to like all the regulations, but we'll see. I think once it does, it will be crazy good. You'll see this chart grow at least 50% more, right? Free cash flow is another thing that's been very great for the company. For the past year, it's grown 8%, right? Free cash flow per share is around $6.11. If you factor in the stock-based comp, which has been leveling off a little bit for the past 2 years, it's been growing slower, which is good. It's leaving a little bit more room for free cash flow. And if you take this into account, this is what it looks like after the stock-based comp. So free cash flow is a little bit stagnant, right? But you have to keep in mind that for especially these big tech companies, free cash flow is going to be manipulated from their CapEx, right? These big tech companies, especially the ones that are pioneering in AI, they're going to have a lot of capital expenditures, right? They're going to have a lot of expenses because they're investing into AI infrastructure. So I wouldn't really look at or base this company off of free cash flow alone. I would also have to factor in, earnings per share, which is growing substantially, right? Every quarter, it seems like it's been growing. Now their balance sheet is very solid, very, very healthy balance sheet, right? Their cash is nearly 10 times more than their debt, and their cash is 5 times more than their debt and capital leases combined. So, I mean, especially during the recession, right? I want to look at companies and look at their balance sheet during the recession, right? Their cash went down a little bit, obviously, during the 2022 market recession, but it wasn't bad. Their debt wasn't increasing, right? If you just look at their debt, it's been staying the same. In fact, it's lower today. So they're able to survive a recession due to all this cash, and their debt is maintained relatively very small. In fact, it's gone even smaller, right? If you look at their dividends, they have now issued dividends to shareholders, which is in my opinion, is like the cherry on top out of everything they've offered to shareholders, right? They already have a great buyback program. They've issued so many of them throughout the years. I mean, if we just look at their buybacks recently, I mean, just look at this. Oh. It's been amazing, right? They've consistently grown every single quarter. They've gone down a little bit, and the reason why is because they've now issued dividends, right? So look at that. It's constantly being added, right? Dividends are making up for that. And I think that's very solid for Google. If you look at the return of capital per share, purely just from stock repurchasing, it's $5.06 per share. So that means every share you invest, you're getting $5.06 back from them repurchasing their shares through their buyback program. So that's amazing in terms of return of capital for investors. And because of their buyback program, they're able to decrease their shares outstanding substantially, right? Every year, it's been going down roughly around 2%, right? Which is just amazing. Basically, what this means is that, or why this is so good for shareholders, is that it increases my ownership of the company because there's less shares outstanding, right? I didn't have to buy any new shares or invest any more capital into the company. They're doing it for me. They're buying shares for me in a way. So looking at the shares outstanding, every year my ownership increases by around 2% because they're buying back shares. If you look at their gross margins, they maintain very good gross margins. And the reason why it's been going up a little bit is because their cloud operating margins might be adding a little bit to that. And their operating margins are slowly starting to come up as well. I think their operating margins actually might increase a little bit. And the reason why is because if you look at their employee headcount, it's very stagnant, right? It stayed the same. They haven't had new employees come to the company. It's just kind of staying flat. I could probably see Google cutting their workforce a little bit because Amazon's doing that already. Since Amazon's been cutting off their workforce because of AI, it increases their operating margins, right? Because they don't have to pay for that much employees. And I think that Google will likely follow the same thing. They will probably cut off their employee, well, maybe not as much, but will definitely cut a little bit of the employee headcount. And you will see the operating margins increase, and same, especially with the profit margins as well. This is what motivated me to buy this company, right? All of the fundamentals we've gone through so far, this company has been very, very good. It's just fundamentally sound. It's a great company, but is it the right time to buy, right? This is where valuation comes in. And as you could see, price to earnings show that Google is cheaper than it was 5 years ago, right? Another thing is that I'm essentially buying Google that's far better than it was 5 years ago, but it's actually cheaper, right? If we look at free cash flow yield, it shows the same thing. For the past year, it's gone up 1%. And for free cash flow yield, lower is more expensive. The higher it is, the cheaper it is. It's gone up 1%, right? It could easily go back down to where it was 2.3%, like a couple months ago, right? Same thing with price to sales. It's cheaper today than it was 5 years ago, and it's a better company today than it was 5 years ago. So the fact that it's cheaper and a better company, that just makes me buy it, right? I think it's a solid company, and I think it's going to heavily grow due to their large capex, right? I'm going to look at their capex and research and development specifically because I think these two are the biggest factors that I look at for Google. So if we look at their capex, it's increased substantially. So this is the reason why the free cash flow is kind of volatile and going up and down a lot. Capex is rising, that's why. Capex includes AI infrastructure investments, business development, business expansions, and probably business acquisitions. So that's basically what CapEx is. So these expenses are essentially going to help fuel revenue more later on for Google. If we look at research and development, it's also gone up. Specifically, I think this is more for AI infrastructure for sure, but I think it's also because of their other bets like Calico, Waymo, and especially their other biotech companies as well. So these expenses will actually pay off. These are paying off expenses. They're not anything bad. They're not anything like crazy. These will pay off in terms of reinvesting back into better products for the company to release. And what I'm going to actually use here is a discounted cash flow calculator that Qualtrim has. Shout out to Joseph Carlson. It's an amazing platform, by the way. But I'm going to plug in, let's just say their EPS growth rate is at around 20%, right? We're going to do earnings specifically because cash flow, like I said, it's too much affected due to their CapEx and their large AI infrastructure investments. So instead, I'm going to use earnings. So it says that their average EPS growth is around 46%. I'm going to be conservative. I'm going to put 20%, right? And their current multiple is at 19, right? Like I said, it's very cheap. I could probably see it go back up to maybe 24. We're looking at a 25% return from today. A 25% return on conservative metrics, right? Let's just say their EPS growth rate is around, I don't know, it goes down to 17%, right? And their EPS multiple goes up to 20. You're still looking at a 17.7% return from today's price. The entry price you would need for a 15% return is $195. Today it's $173. So I think it's undervalued substantially. Now for the timeline of how long I'm going to hold this position in my portfolio, I honestly think I will hold this for a minimum 3 to 5 years. That's minimum. Maximum will probably be in the next decade. And I won't sell any of it. And the reason why is because I honestly see that this company will be very relevant within the next decade. It will continue to grow. It will continue to mature and return back its capital to the shareholders. So yeah, the timeline for this position will likely be 3 to 5 years. Throughout my investment journey that I'll document, you will likely not see me sell until it's super overvalued. And even then, I'll just trim the position. I would never sell fully out of it. Or if I see something fundamentally collapse in the business or in the company, right? But I think that's highly unlikely. I think it's more likely that it will be super overvalued. And if it does get super overvalued, I'll probably just trim a little bit of the position. So yeah, I just wanted to make this video to show why I invested in Google. I find this fun. I like documenting this stuff and just going over it with you guys, right? So if you guys want, I could probably make some more videos on other companies that I have in my portfolio. And then we could just do like weekly updates on my portfolio. How is it doing? How is the market doing? And all that stuff. But yeah, I hope you guys enjoy this video and I'll see you in the next one.